Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to be discussing scanning and backtesting IV rank and percentile in the ORATS dashboard. Matt, do you want to share a screen and get us started?
Sure. Yeah, so let's talk about IV rank and IV percentile first, and just what they are, and then we'll get into it.
Yeah.
So implied volatility comes from option prices near, in our case, the 30-day to expiration. And when you're valuing those options using a Black-Scholes formula, you solve for the implied volatility, and that gets a price that matches what's in the market, and that's what's called the implied volatility. And we use a percentile or a rank to figure out where those measurements are compared to all the other ones in the over a certain period of time. You know, over the last month, over the last year. So far, so good.
Yeah, so it's a historical metric for the most part. So you can kind of see how it did versus its history and kind of get a feel for it.
Yeah. And now I'm typing into to auto and see if it'll help me out know the difference between implied volatility percentile and implied volatility rank. And so as you may or may not know, auto is our AI agent that can answer questions for you. So let's look at what they wrote. So the rank measures a low and a high, and then measures like where it is in that range, like what percent of that range is where we are currently. The percentile takes the number of trading days that are the percentage above or below, and puts those in. So it's slightly different, but usually matches pretty well on those. So so far so good on that, Tyler.
Yeah, let's get into it. I see you got some charts pulled up.
Yeah, so let's so we could use, so we could now compare the IV rank with the IV percentile. Now, you could tell right away that there is a difference between the rank and percentile. And it's interesting. And I wonder, I'm going to put you on the spot and try to figure out why the rank would be, so different right now than the percentile. Do you have any idea on that? Because right now the percentile is showing, the volatility going up, and it's going up quite rapidly. The rank is not as high.
Yeah, I don't know. I'm actually curious what you have to say. I don't have
Yeah,
a reason.
so this is like I prefer the percentile, and this is a great illustration of that. And the reason is because if you get one outlier, like, because the rank only measures the absolute high and the absolute low over a certain time period, in this case a year. Well, we had a really high April volatility. That was the tariff day, and the vol went extremely high. So that's the only point that it uses. Like, so it's going to be tough to get a high percentage of that rank. Whereas percentile uses the number of observations and measures that against it. Does that make sense?
Yeah, so rank is more sensitive to outliers.
Rank is much more sensitive to the one big outlier that it had. Exactly.
Gotcha. So yeah, and I mean my theory here, I guess, is that the percentile is probably better to use in most circumstances because you don't typically want to use data sets that have a lot of outliers and are sensitive to outliers.
especially in a measurement like implied volatility that can have one big outlier of a day. You
Right.
know, if it's price, then, you know, if you're just looking at price rank or price percentile, that's less that's less volatile than implied volatility. So I like to use percentile. So, you know, people might ask, well, when do you use rank and when do you use percentile? Again, this is a perfect illustration because the vol's high right now. You know, we have if you're looking at this later, we have the whole Iranian debacle thing going on. So it's high volatility. So that's the first thing I want to mention. And then what we could do is we could go in and find certain securities that are high or low vis-a-vis, you know, the rank. Does that make sense?
Yeah. So like stock scanning, what you're talking about.
Yeah. So now, like, you know, because, you know, the title of this show is Implied Volatility Rank and Percentile Used in Scanning and in Backtesting. So, you know, so let's look at how we might do that. So I like to start from this beautiful welcome page, and I could go find my implementation stock scanner, and I could go from there. Now I've already started this just right before the show. I said, okay, well, I want minimum stock price in there. I want minimum rank, or I just want rank as a display item. You know, I have implied volatility percentile here as a monthly. Maybe I'll look at implied volatility. Maybe I'll just use that as a display only, and I'll look at implied vol. I like to use 1 year percentile. So we'll do that, and we'll do. I want to find anything that's lower than you know, lower than normal. I doubt we're going to find many. So Tesla has a IB percentile 1 year only in the 20th percentile. So that's interesting. So that Tesla, and here's another electronic car, TLT is not very high. So you know, so this is kind of an interesting list that we're pulling together here. You can see the underscore C's. That's the average for all the components. So that they're showing up here, but you know, there are ways to get rid of them, but I'm not quite sure how to do that right now. I think we just do greater than 0. We should come up with something in here to get rid of those. But anyway, so we could come up with this kind of formula to find, you know, anything cheap right now. Does that make sense?
Yeah.
I'm going to close my door because my dog came in. Didn't you? So now what we could do is save this scan and then use this scan to find, you know, option trades. So in this case, these are even though they're in some cases high, we could use these if we, you know, you might say, oh, the horse is out of the barn is an old saying. That, you know, there's nothing to buy out there, but these volatilities are still somewhat low compared to where they've been. So we'll take a look at these. So let's go to the options scanner, and I clicked template, but let's go to the options scanner, and we won't use it in symbols. We'll choose that stock scan. So it brings in these names, and then we need to then pick a strategy. Well, we don't want to pick an iron condor strategy because that's a short volatility strategy. This is a long volatility strategy that we're looking for. So, you know, we might do like a long strangle, let's just say, and we'll take care. We'll kill that. And now how long? Maybe we'll do a little bit less. So I'll pick 2 weeks, and then maybe we'll go out a little bit, you know, delta wise. So 25 delta. We could tighten this up. So it's 20 to 40, and then anything else that you could pick here. You could narrow it down, but so it looks like TEM is coming through. So let's look at this TEM. First of all, I like to go to the trade builder because I'm not that familiar with TEM. And you could mouse over it. It's a healthcare technology. So I mean, it's not really well, unfortunately. So we're seeing some DNA and RNA, and so it's probably has something to do with so probably we don't want healthcare. So we could go in and take out healthcare, but I'm not too fond of that because healthcare stocks trade mostly on, especially like TEM. So I could find this in the list and take it out. And so because I don't want something like that. But here's that IonQ stock. Again, we could pull up the trade, go to the trade builder, IonQ, what's at the bottom here? This is a technology, computer hardware, quantum cloud. So this might be something where, we might get some more volatility. Volatility is not that high in this particular stock, which is interesting because almost everything else is high. So we can now, and then, we could view what the percentile is, and it was higher and it came down. It had earnings not too long ago, and now it's kind of in between earnings. So this, the thing I like about the trade builder is it sets up your trade around the, and in line with the candlestick chart. So that's kind of nice. So we'll click up here.
You're kind of hoping it stays between those two lines.
Opposite.
Oh, opposite. Okay, it goes beyond those two lines.
Yeah, this is a long. Usually we're doing short strangles, but this case is a long strangle. So and it'll be a little bit more clear. You could view this in the risk profile page. And so the risk profile page is a new page that we have that shows the trade in a lot more detail. So we could see, okay, well, we have 10 days on this trade, expire, or 9 days, and we could see where the break-even points are and where the stock is now. So it doesn't have as much detail as we did before, but we do have a graph in the page that does have kind of where the how far the stock has to go, and you could point this at different things here. So that's kind of nice. A little bit of stuff going on in the background, so it's hurting my performance of my machine here. But
so our theory is that the IV is going to go down a little bit by expiration.
No.
Or go up.
This is you're still thinking about a short strangle. This is a long strangle. So we want implied volatility to go up. But what we're seeing here is the short term is very high, but the kind of medium term is lower. So and this graph actually does show the problem, and kind of I think what you were thinking about, like this volatility would be a lot better. So that's a good point. So like that volatility does look high. Again, if that came down, you could see this purple line going down, and that's what would happen. So you're kind of right there. So what we should probably do is go back to the scanner and do the 1 month, since the IV percentile is built on 1 month. We should be looking at the 1 month volatilities for those stocks. You with me?
That makes sense. Yeah.
So here's a longer term one. So, again, when we look at the adjust the IV, then that one's a lot lower. It's not the lowest April 2nd, but still pretty close. So we like, that vol a lot better. I think that's what you were.
Yeah, that
were
makes
thinking
sense.
about. So maybe what we could do is put this. We could put this trade on in our paper trading. So I have to go to my positions, pull up the paper trading, and then go back to the trade, and we'll see paper trading here, and then so I like to when I'm picking a spot out. So this is a relatively wide bid ask. So are we going to get filled at the middle? We've talked about this on other shows. We think this should be worth 246, and we've talked about that in past times, looking at the option chain and how we're drawing the SMB through it. So I don't think we'd get filled there. We could either type it in here. We could probably get filled at 45, probably at 50. So we'll put it in at 45. We'll force that. So we have kind of a game theory thing that does the fills in here. So what I like to do when I put on a trade is go in and look at that trade and add an alert. I have some historical alerts in here, so I could say, let me know if the profit is here, and so then I could then say, this is the Tradier hub for 3.3. And then I could track that, see how we do. So far so good on all that, and you can see the alert here.
Yeah, I like the alerts, especially for the profit and loss thing. Yeah, I'd be curious. So are there we just looked at IonQ. Is there a reason that one in particular you kind of picked out?
Well, I liked it because it was still a stock that might move a lot if a lot happens in the market. And so I figure, well, let's find a stock that what we're trying to do is find a stock where the vol hasn't gone up that much. And
right.
IonQ was I think especially those later months were especially low compared to where it's been. So I mean, the whole reason that we've done this search is because we're looking for IV percentiles that are low relative to everything else.
Yeah, that makes sense.
Yeah. So that's the reason that we're doing that.
So we mentioned backtesting in the title as well. Are we going to look at some backtests or backtest this particular strategy? What are we going to do?
Yeah. So so the next thing is, well, let's do some backtesting of some of these things. So we'll go to the advanced backtester, and we'll test out the strategy. So let's test out a long strangle, and I think I went down there, and we'll just do it for SPY. But so then we'll look at what are the entry parameters, right? So first of all, what I like to do is just run this, run it on its own. So let's just that's just running it, just getting in and getting out every time the backtest enters or exits. But in this case, we'll use entry triggers. So we want to enter every time the implied volatility percentile is let's say, what are we doing, low? So we'll do a minimum of 5 because you don't want 0 or something, and then maybe a maximum of 40. So typically somewhat low. And so we'll run that.
Well, we're also looking at a ratio too, right? Because we're looking at it in comparison to the month.
I don't understand what you're saying with the ratio to the month.
Well, when we did I thought when we did the stock scan, we were kind of comparing it and seeing what, if it had more move to go.
So when we were doing, well, I think what you're saying is, and it's a good point. Like, you would do you would do a ratio, to the, to like the overall market, right?
Yeah, you
Like
could do that too. Yeah, I mean, there's a lot of interesting things you can do here, right? You could compare it to the SPY_C.
that, yeah, right. So you go SPY_C. And so now we're seeing, you don't have to type this in, but because it goes like, SPY is the divided by the SPY XLC. And then, so then this ratio, we just want to see something under 1, right? So,
Yeah.
that would be your entry point. And so we could send that as an entry point. So that's a good point. That's another way to look at it. And then, another thing we could do is set up exit parameters, like, because we're getting in, but would we get out when that flips? Like you could do profit and loss, but you could also do, well, if that flips, do you want to get out, right?
Right.
So, this we'd set up this, you do a ratio, and it's, and then I think you still set it at the same thing, because I'm almost positive, but the exit trigger, it's a little counterintuitive, but that's how you do that. So close the trade when it falls within this. So I might be backwards on this, but let's just run that.
Yeah. Well, that's the same thing as what we did for our entry.
Right, but I think what it's just how the rule works. So I might be wrong on that. So let's just, in this case we'd go over 1, maybe 1.05 or something. All right, so
we got our first test back.
Yeah, so the first test we'll just say no entry exit nor exits. All right, so let's take a look at that. So here's a typical long strangle, right? And then you can change this to see a little bit the graph a little bit better. But yeah, it's going to do really well clearly when you get a lot of movement in the underlying stock, right? So I like to look at the monthly returns, and so this looks uglier than it is. You don't need, this is just a volatile strategy, right? So this is showing like a lot of big moves. So we could look at some of the trade logs and see what's going on here. You get in at 607, but you do the 622, 595, and if it doesn't go outside of that, you're going to lose. However, on this one, it did clear outside. So that's how a typical long strangle works. And now we've got another one. So we've got so we've got this one, and this is the one where we got in. This is the the low percentile, right? So the problem with this one is, and then problem with this is I can't remember what it is.
I think we did a ratio on that one.
Okay.
That one we added the
We edit it.
the ratio.
Yeah. Yeah. Okay. So that's the ratio one. So, and there was no exit.
And then there were 2 exit ones
All right.
that are
So yeah,
coming
right.
up.
So this is the ratio of IVP to the underscore C. And that is better, right? So let's take a look at this, but let's take a performance metric. So this is in the market 50% of the time. So that's decent. So this is one that, you could tell it isn't as ugly as the other one. So this is more tradable than just, the other one right off the bat. So negative 1.39, negative, just on a low percentile. Because what happens with the low percentiles is, a rule of thumb that we've kind of found out from doing all these back tests are that the market doesn't get the volatility low enough when it's low, and doesn't get it high enough when it's high. And how this manifests itself during this thing is like we're looking for a low percentile, but it's not moving that much in the low percentile times is what this is saying. Does that make sense?
Mm-hmm. Yeah.
And then the ratio, still captures some of the, the other, like this is proving to be the best so far. So, and that what that's saying is it's looking at all the components and seeing if, when that ratio is in, kind of in the perfect time. So you're still getting in to the market, in times of duress, like, so you got, 2008, September, the bad times, even though you have this ratio, whereas the one, that really did poorly in the low percentile, and those ones you got in, but not at the, probably a little bit late on these, although you did get a good one here. So, but you were just in at other times when the market wasn't looking that good.
Right. Is this, just curious, is this a good thing to optimize? Like, could we use the optimizer on the base test that you're doing there,
Yeah.
and seeing what we can do?
Yeah, definitely. So yeah, you could send this to the optimizer. As a matter of fact, you could look at, so the optimizer, what it does is it looks at, looks like there's a lot of things that might work pretty well for this. And so we look at, if we use these certain ratios, can we improve the performance? And the p-value shows what percentage of that is due to chance or not. So it does look like there's some good opportunities here. And this is, generally the way that, like, an easier way to find these types of strategies. But here's the IB percentile, and what they're saying here in the IB percentile, and you can see the details, is you want to get in when the IB percentile is actually greater, right? Is that what I'm reading? And get out when it's lower.
The 10-day moving average is greater than the 30, so it's yeah. I mean, basically, when the short term.
You want to get in when it starts to move. That's what this is saying.
Yeah,
and that's kind of what we're seeing, right? Like, and if you do it that way, you could get this positive.
Mm-hmm.
So this improves it on almost everything. So you could even save that to your back test, and I mean, you've been in. This green part shows when you're in, and you're in right now, and you've been in and doing well for the strategy. So that's like, I think that might be the lesson, Tyler, is kind of the opposite how we started things out. Well, we started things out looking for stocks that hadn't got to the higher percentiles yet, but these ones have got to, what this optimized backtest is saying, for especially for IB percentile, is on a short-term basis, 10 days divided by 30 days. If the smooth moving average of the 10-day, and that's this kind of blue line. So when the blue line crossed here is when people started saying, it looks like there's going to be more volatility in the market. And that's when you get in.
Right.
Because holding, we saw what happens if you hold a long strangle, you're just going to get eaten up. But if you get in as the vol is going up and something's happening, those are the good times. So, and this is also saying get out at certain times too. You could tell sometimes were false positives, like in this time, when you weren't doing that well, it was getting you in and getting you out, but like it holds on at certain times. So that's a real interesting thing. So I put this in my, save back test, long strangle. So I'll turn this auto trader on, and you can see that it's green right now. That means it's in the market, and you could see the optimizer and the back test for this. So so why don't we leave it there, Tyler? We did, scanning, and we did back testing, and then we optimized, and we found out when the best time is to get in using the IB percentile, which we think is a better indicator than the IB rank.
Yeah, it's nice to see the optimizer showing us some good stuff here. It's a complicated tool, but as you can see, obviously very powerful when used in the right way, especially for a strategy like this one where, getting in and out at certain times where, you're trying to catch the IV rise before it happens is, that's when it really becomes powerful. So yeah, great show, Matt. Thanks for explaining that and the differences between rank and percentile there. It's a common question. If you guys do have any questions, first ask the Auto AI chatbot on the dashboard. It's very helpful at explaining indicators and how to use them. And then you could email support@orats.com as well if you have any questions about your subscription or things like that. Awesome. Well, thanks, Matt, for the great show. We'll be back again next week. Thank you, Tradier, for hosting us, and we'll see you then.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.